Today we're going to be talking about the importance of trading volume. I'm also going to be discussing why you shouldn't automatically discount stocks that have a low volume. And I'm also going to be leaving you with some ways that you could use volume in order to predict price action. As always, the only thing that I ask of you is that you hit that beautiful like button, and also if you see value in this video, subscribe for more short, sweet, and simplified videos on how to trade the stock market. Volume is a measure of how much a stock has been bought or sold within a given period of time. This is the volume indicator, and it shows you the volume calculated per time slot. So the reason this is important is because whenever you buy shares, there also needs to be someone or something on the other side to sell you those shares, and vice versa. The price action that we see on these charts is the constant battle between the buyer and the seller, both trying to get their hands on the best deal possible. Now, the reason high volume is important is because it allows for liquidity. It provides this liquidity because a lot of people buying and selling shares allow you to move into and out of positions very quickly and easily. For example, if you're trying to sell 2,000 shares of something in a stock that has a daily average volume of 2,000, then it's going to be very hard to sell your shares. And as traders, it's key to get into and out of your stocks as fast as possible. Over the course of a day, there's only 2,000 shares traded in total. How are you going to get your 2,000 shares sold within the time span that you need it to? Another problem is that if you're one of the only suppliers or sellers and you dump shares onto the market, your shares are going to be executed at lower and lower prices. So the next step is identifying what high volume means. What level is high volume? So to me, high volume for a day trading position is any stock that is trading over 100,000 in shares. For any swing position or position lasting more than a day, as a general rule of thumb, I like 50,000 shares. So the swing trading one is about half as much as the day trading one in terms of what I'm looking for. The reason that volume isn't as important for swing positions is because these longer positions aren't so much about focusing on selling out the minute you see a reversal, but rather seeing a more prolonged downtrend. And honestly, odds are strong that 50,000 in volume is probably going to be more than you need anyhow, but I like to be a little cautious with this just because I know a lot of people will get stuck in positions if they misunderstand what I'm talking about. Now, that being said, I highly recommend adjusting accordingly, but these are generally the rules that I go by. Okay, so this brings me to the next point. You may notice that volume fluctuates throughout the day. Also, daily volume can fluctuate from day to day, so you have to be really careful of this. So this is where a lot of people get confused. And advanced traders often get upset when I'm referring to specific stocks on my watch list because they're like, "Oh, Charlie, you're really stupid. You're recommending low volume stocks." I talk about stocks that are going to be releasing FDA approvals or trial results on a certain date, and I also talk about different news that could lead to spikes. The thing is that a lot of these stocks do have pretty low volume for the rest of the year. So the key is you need to understand how time frame is important in judging the volume of the stock. If you have a stock with big news coming out, it's likely that on the days leading up to, and especially on the actual day of the news, your stock is going to see a huge growth in volume. But don't take my word for it. If you look at SCYX, we see lower volume all the way up to a few days before the announcement. Then we see a slight running up of volume a few days before, and then boom, on announcement day, a huge increase in volume. So my point is that discounting stocks with potential specifically because they have low volume is a dumb non-starter strategy. Obviously, you don't want to buy a stock when there's low volume, but if you're under the impression that volume never varies much, you're greatly mistaken. Now, that being said, most of our day-to-day positions aren't based off singular announcements, but generally changes in price action. In these situations, we're going to need to find time points that have high volume to trade off of. Now, generally, there's usually two main points of the day that have the most volume and usually movement. That is the first 30 to 45 minutes of market open and the last 30 to 45 minutes before market close. If you look at Apple, you see this really huge difference in volume. But the market standard's really not that polarizing. I just wanted to show you this example so you have an idea of what I'm talking about. Let me pull up one that's a little bit more realistic in terms of what you're going to be seeing on a day-to-day basis. The chart of Tesla displays a lot more of how, on average, you'll see a lot of these mainstream stocks trade. We see a large amount of volume throughout the day, but a noticeable difference in the first and last parts of the day. As a result, a lot of the opportunities are in this time period when you have the high volume. But there's also events such as news release or some sort of other type of press coverage that brings attention to the stock and then pushes up the volume. Sometimes such a rapidly increasing stock price could also create volume as more and more people buy in, or in the case of a rapidly downtrending stock, sell the stock. Also, for those of you who are wondering why I don't trade or recommend trading during pre and aftermarket hours. That's super relevant to the topic at hand. It's precisely because the volume is so low and the prices can be so sporadic since there's not many shares changing hands. When the volume is performing at such a low level, a lot of the technical indicators that we use, such as support and resistance, even the RSI and the MACD, they're just not going to be rendered very useful because of the fact that the price action is not very realistic. When you only have a few shares trading hands, when people are buying and selling, it's not going to be a very realistic price. The market price is just all sporadic. Let's now talk about how volume relates to price action. So if you have a stock that is climbing in price, an increase in volume will generally push it more in that direction. Likewise, if it's decreasing, then an increase in volume will push it more in that direction. Of course, there are exceptions to this, but generally speaking, you'll find this to be true. The reason behind this is intuitive. As the stock price climbs higher, more and more people buy in or sell out depending on the direction of the stock price. That moves the price action more in the direction that it was already going. Okay, so what should you do if you're trading a stock that had high volume when you executed into your position, is downtrending, and you don't know what to do? Now, I have a different approach to this than a lot of other traders. So you may want to find out what works best for you, but generally speaking, if I see that my ratio of downward potential to upward potential is in my favor, I'll generally hold my position until I see signs of a reversal, just like I normally do in all of my trades. However, if the volume is steadily dropping over time, I'm eventually going to sell out of the position regardless, just because it's not any use to hold an uptrending stock that has literally no volume and you can't get out of the position. But that being said, I generally trade stocks that have a huge amount of volume, so this isn't a huge problem for me. But with some penny stocks, a lot of them you will encounter this problem with. The reason for this is because penny stocks don't generally have the advantage of getting the massive amount of trader and algorithm coverage that mainstream stocks like Tesla and Apple and all the other ones do. The exception to this might be a lot of the marijuana penny stocks. They generally tend to get a lot more coverage than others, but overall, you might have this problem if you trade in any type of penny stock. So to mitigate this risk, you're going to want to be extra careful with volume when you're looking for a position in penny stocks. In summary, when you're trading stocks, you want to have at least 100,000 in volume in terms of a day trading position and 50,000 in volume in terms of a swing trading position. The average volume is a good place to start, but in terms of news reactions and earnings, other things that are media coverage and emotionally driven, a lot of those times it doesn't really matter as much as long as it has growing momentum in terms of volume on the time leading up to that. But overall, with most of your positions, you're going to want to have 100,000 in average volume and 50,000 for the swing positions. Anyways, I hope this video was helpful. If you have any more questions whatsoever, I highly recommend that you check out our ZipTrader Circle group. It's a free Facebook group. We answer a lot of different questions, and there's so many great people on there, so I highly recommend that you check it out. Have a great day, folks, and I'll see you in the next video.